Howdy, Jacob here. Today we're looking at Abercrombie and Fitch. Abercrombie and Fitch company in the specialty retail industry, 7.1 billion market cap on 6.4 billion enterprise value. Some interesting things here. I mean, what I know about Abercrombie and Fitch, you go to a mall and you see, the crazy, it's like a little bit dark store. You walk in, it's that U shape and everything. Well, I guess maybe a W shape, whatever. Um, and they're known for their models and everything. I was very surprised to see that pre-COVID, even pretty much declining revenue. Roughly flat, but probably 1%, -1% CAGR. And then post-COVID, they have the highest revenue they've ever had with the greatest operating margin that they've ever had, greatest return on invested capital. I found that very interesting. I know some stores honestly have great returns on invested capital, meaning that they just put down a store and get a great return on that investment, at least historically. But here, it looks like they cut this dividend from COVID, and then they just been. Last year maybe or 2 years ago, not so much, but like even if you take 3 years average, great production of earnings there. So let's look more into income statement. Let's see. Okay, so cost of goods sold relatively flat, revenue up a tad, sales general admin somehow actually flat with inflation. That's crazy. They must have laid off some workers, I presume, got rid of some stores. Share count way down, 72 million to 50 million. That's a good lay down, but again, share purchase is still an investment in the business, so you want to be buying them at extremely cheap prices. 901 million cash on hand. 222 long-term debt. We're not concerned with that balance sheet. You got enough cash to write it right off. No concern there. Solid production of free cash flow. Same with earnings. 2023 was a little bit of a down year, but if we look at a 5-year average basis, probably looking at 200 million production of free cash flow with a big going to debt reduction, majority going to share repurchases. Again, they stopped that dividend right when COVID happened, pretty much. So, yeah, free cash flow looks better in earnings. So that's another positive thing. Let's start making some assumptions here. This is interesting. So, on the revenue growth side, I really don't think we're going to be seeing much here. I didn't see a line for acquisitions, but I wonder if they're making some acquisitions. I don't know. I don't think there's going to be much growth here, though. Let's say 2%. 13 on the price to earnings and free cash flow. I'll probably do closer to an average here because it's been very high recently. I just question whether they're able to keep that up or not. Maybe let's just do the average of the last 3 years. Let's do 5, 5.5, and then buying back shares, not so much recently, but 1% would really just be $71 million. Offset stock-based compensation, 100. Yeah, maybe not. Let's keep that relatively flat. Let's say they buy back enough to offset stock-based compensation, nothing more. And whoa, okay. We're saying it needs to fall 83% to get to the price we're looking for. But again, everything's the present value of earnings and free cash flow. Not everything. I just went over a video where they two other reasons to, or I guess a week ago or so, I went over 2 other ways to buy a stock. But a lot of companies are present value of earnings and free cash flow. And here, I just don't think. I think people are weighing the recent earnings and free cash flow margins a bit higher. Which if you understand this business and that's what you're comfortable with, then absolutely. But for me, I just don't know the business well enough, so I'm going to stick with the average margins here. And when I do that, it definitely looks to be overpriced to me. But I do hope you enjoy the video. Have a great day. Thank you.